Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that's crucial for any investor, trader, or even just someone curious about the world of finance: how to monitor economic news and events that shape market trends. It might sound complicated, but I promise, by the end of this video, you'll have a clear roadmap to follow. So, why is this so important? Imagine trying to sail a ship without a weather forecast. You might get lucky, but you're far more likely to run into a storm. The global economy is that weather system, and economic news is your forecast. These events, from interest rate decisions to employment reports, are the winds and currents that move the markets. By understanding them, you're not just guessing, you're making informed decisions. You're moving from being a passenger to being a navigator of your own financial journey. Let's start with the big players, the heavy hitters of economic news: central banks. Think of the Federal Reserve in the US, the European Central Bank, or the Bank of England. These institutions control monetary policy, which is a fancy way of saying they manage the supply of money and interest rates. Their announcements are arguably the most powerful market movers. When a central bank raises interest rates, it becomes more expensive to borrow money. This can slow down the economy to fight inflation, but it might also make stocks less attractive compared to safer assets like bonds. Conversely, when they lower rates, it's like hitting the accelerator. Borrowing becomes cheaper, encouraging spending and investment, which can boost the stock market. So, how do you track this? Mark your calendar for their policy meetings. The FOMC, or Federal Open Market Committee, in the U.S. meets about 8 times a year. The dates are public knowledge. After each meeting, they release a statement, and the chair holds a press conference. Don't just read the headline of whether they raised or lowered rates. The real gold is in the language of the statement and the Q&A session. Are they hawkish, meaning they're concerned about inflation and likely to raise rates? Or are they dovish, signaling they might lower rates to support growth? The market hangs on every single word. Next up, we have key economic indicators. These are like the vital signs of an economy. The first one you absolutely must know is GDP, or Gross Domestic Product. It's the total value of all goods and services produced in a country. Think of it as the economy's report card. A growing GDP signals a healthy, expanding economy, which is generally good for businesses and stocks. A shrinking GDP, on the other hand, can signal a recession. GDP reports are usually released quarterly, and they have a huge impact on market sentiment. Another vital sign is the employment report. In the U.S., this is the non-farm payrolls, or NFP, report, which comes out on the first Friday of every month. This report tells us how many jobs were created or lost, the unemployment rate, and wage growth. Strong job growth means people have money to spend, which fuels the economy. Weak numbers can spook investors. Again, the devil is in the details. High job growth is good, but if wage growth is too high, it might fuel inflation, which could lead the central bank to raise interest rates. It's all connected. Let's talk about inflation itself. The most common measure is the Consumer Price Index, or CPI. It tracks the average change in prices that consumers pay for a basket of goods and services. When CPI is high and rising, it means your money buys less than it used to. This is a huge concern for central banks, and as we've discussed, their primary tool to fight it is raising interest rates. So, CPI release days are always high volatility events for the market. Beyond these big three, GDP, employment, and inflation, there are other important indicators. Retail sales data gives you a snapshot of consumer spending habits. Manufacturing and services PMIs, or Purchasing Managers Indexes, survey business managers to gauge the health of those sectors. A reading above 50 indicates expansion, while below 50 indicates contraction. Consumer confidence surveys are also valuable as they measure how optimistic people feel about their financial future. which influences their spending decisions. Okay, so we know what to look for, but where do you find all this information without getting overwhelmed? First, you need a reliable economic calendar. Major financial news websites like Bloomberg, Reuters, MarketWatch, and the Wall Street Journal all have excellent, free economic calendars. These calendars list all the upcoming data releases, their expected results based on economist surveys, and their potential market impact, often rated as low, medium, or high. This is your daily or weekly guide. You can filter it by country and importance to focus only on what matters to you. Second, choose a few high-quality news sources and stick with them. Trying to read everything will just lead to information overload. Find sources that provide not just the news, but also insightful analysis. Watching the main financial news channels can be helpful, but also be aware of the constant noise. Sometimes, reading a well-written article that summarizes the day's events is more efficient. Third, leverage technology. Many brokerage platforms have built-in news feeds and calendars. You can also set up alerts for specific keywords or economic events through various apps and websites. For example, you can get a notification sent to your phone the moment the CPI data is released. This instant access is a massive advantage in today's fast-moving markets. Now, let's put it all together. It's not just about knowing that a certain report is coming out. It's about understanding the context. Before a big release, like the NFP report, you should know what the market consensus or forecast is. This is the number that most analysts are expecting. The market's immediate reaction is often based on the surprise factor, the difference between the actual number and the expected number. If the actual number is much better than expected, you might see a positive market reaction. If it's much worse, the opposite can happen. Sometimes, the reaction is counterintuitive. For example, very strong job growth might cause the market to fall if investors' fear will force the central bank to raise interest rates aggressively. This is why you can't just look at one piece of data in isolation. You have to connect the dots. How does this jobs report affect the outlook for inflation? And how will that, in turn, influence the central bank's next move? This brings us to a final, crucial point. Don't just consume the news, analyze it. Think like a detective. Ask yourself why and what's next. If a company in a specific sector reports poor earnings and blames supply chain issues, that's a clue. Is this an isolated problem? Or could it affect the entire sector? If a geopolitical event happens in a major oil-producing region, how might that impact energy prices, and what effect will higher gas prices have on consumer spending and inflation? Developing this analytical mindset takes time and practice. Start by focusing on one major economy and its key indicators. As you get more comfortable, you can broaden your scope. Remember, the goal isn't to predict the future with 100% accuracy. No one can do that. The goal is to understand the forces at play, though you can make smarter, more strategic decisions and manage your risk effectively. By consistently following the news and thinking critically about its implications, you'll be light years ahead of those who are just reacting to headlines. Thank you so much for watching all the way to the end. I hope this guide helps you navigate the exciting world of economic news. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe and hit that notification bell so you won't miss our future content. Drop a comment below with any questions or topics you'd like us to cover next. Until then, stay curious and invest wisely.